Home prices rose a better than expected 3% in September. It's the biggest increase in more than 2 years. But will the housing recovery last? Well, for his thoughts, I'm joined by Rick Sharga. He's Executive Vice President of Carrington Mortgage Holdings. Well, Rick, home prices have now risen for 8 months in a row, yet prices are 30% below their peak level. So how would you characterize this stage of the housing recovery?
I think that the important thing to call this is a recovery, but it's a nascent recovery. It's in the early stages, and it's going to be a very slow, gradual recovery over the next few years while we work through a backlog of distressed homes and get through some other headwinds that'll keep the market from exploding.
So now at the point where you can say sustainable?
Yes, we are sustainable, but we're only one bad economic event away from it tumbling back down.
Well, yeah, this time, even Atlanta was up. That market's been down for almost 2 years, just about. What does that tell you? It's up 1.7%.
Yeah, we saw Phoenix up about 20%. Atlanta, not a big surprise to me either, because what we're seeing is a lot of investor interest, a lot of investor activity in Atlanta. They're still having a hard time getting loans for people who want to buy homes in Atlanta, but there's a lot of cash going into the city, and investors are looking to buy a lot of those properties and turn them into rental units.
You mentioned Phoenix, Rick. Phoenix is up 20% year over year. That was, of course, one of the hardest hit markets in the recession. So what we're seeing in Phoenix, is this a sign of real strength, or is it just a bounce back from an exceptionally low level?
Okay, there's two things driving home prices in general, and Phoenix is a microcosm of both of them. One is that there's a lack of inventory. Okay, we've had new home builders building below replacement. We've had a delay in distressed properties getting into the market, and current homeowners, or 30% of them are upside down on their loans that can't sell. So there's a lot of people going after not a lot of inventory. Exacerbating that is Phoenix was the first target market for a lot of institutional investors going in to buy vacant foreclosed properties and turn them into single-family rental units. So the combination of those two things drove Phoenix prices really almost artificially high, but I think at this point it is probably a sustainable level of home prices.
Well, Hurricane Sandy struck the heavily populated East Coast. What impact do you expect that to have on the housing market or the recovery?
Yeah, that's always a tough one to try and predict what's going to happen after a natural disaster like Sandy. We do know that Sandy decimated parts of Jersey and New York, some very expensive properties, also a lot of vacant properties that might have sat vacant for some time to come. I think the net effect eventually is that we'll see a positive uptick, but short term I think it's going to delay the recovery a little bit just by kind of putting the brakes on home buying and home building activity until people figure out just what the damage assessment looks like.
So this win streak so far in home prices, do you think that could possibly stall?
We're in a down period of the year, and New York and New Jersey certainly are variables right now because we don't know what's even going to be available to sell. But so we could see prices tick down on a month-over-month basis. But it would not at all be a surprise to see on a quarter-over-quarter or year-over-year basis the prices continue to go up. I don't see any organic reason why home prices should fall for the foreseeable future.
As you mentioned, we're entering that seasonally weak period of the year, and just at this point we're talking about the fiscal cliff.
Right.
What impact could that have on the housing market?
The fiscal cliff could be the housing market's worst nightmare. I mentioned we're probably one bad economic event from the housing market coming undone, and that would be the worst economic event. The combination of a spike in unemployment, a spike in taxes, which means that potential buyers would have less disposable income to use, and a devastating hit to consumer confidence would probably knock the stilts out from under the housing market. If there's one event that could send the housing market back into recession instead of recovery, it is absolutely the fiscal cliff.
And if January 1st comes around and we have gone over that cliff, what will happen to the numbers?
Well, you'll start to see home prices go down. You will probably, if they go down far enough, you'll probably see a subsequent wave of foreclosure activity. A lot of this will be driven by unemployment, which is almost a guarantee if we have the fiscal cliff scenario. Now, this won't all happen January 2nd. So if we do theoretically go over the cliff, there's also degrees of how bad it'll be depending on how long it is.
All right. Thanks a lot, Rick, for joining us.
My pleasure.
Our thanks to Carrington Mortgage's Rick Sharga. I'm Fred Katayama, and this is Reuters.